Restaurant Brands International is a multinational fast food holding company. It was formed by a merger between Burger King and Canadian coffee shop and restaurant chain Tim Hortons. The company expanded in 2017 when they purchased an American fast food chain, Popeye's Louisiana Kitchen. And in December 2021, they bought Firehouse Subs for $1 billion. So they are expanding all the time. And Restaurant Brands International is currently the fifth largest operator of fast food restaurants in the world. So it is a massive company made of a number of very strong brands. But is it a good business? And furthermore, is it a good investment? Let's find out. First, let's see who owns this company. Individual insiders. That is an X. Individual insiders own 1.6% of this company. And we would like to see a number over 2% because then we know that they have their skin in the game. But most of the leadership and board members have some shares, so it is not that bad. And are individual insiders buying? That is an X. For the last 12 months, we almost only see sales from individual insiders. And do super investors own this company? That is a check. There are 3 super investors that own this company, including Bill Ackman. And I did a video on his portfolio, so if you want to check that out, then the link will be in the description. And are super investors buying right now? That is also a check. Bill Ackman and Lee Ainsley bought over 375,000 shares in the third quarter of 2022. So it is a mixed situation. Insiders are not interested in buying right now, but some very smart investors are. And now let's check the financial health of Restaurant Brands International. Return on invested capital. That is an X. It is 3.4% and we want to see a number higher than 10%. So that is not a great beginning. And free cash flow growth? That is a check. It is 24%, and just as with return on invested capital, we want to see a number over 10%. So this growth is really nice. And what do we know about net profit margin? It is a check at 15.1%. It is a very nice profit margin since the median for the sector is 5.1%. And that shows us that Restaurant Brands International has a lot of pricing power. And now let's take a look at shares buyback. That is an X. Since IPO, which took place around 8 years ago, they issued 29.6% extra shares. So that is not good because shareholders are getting diluted quite substantially. And the debt, it is also an X. It would take almost 10 years to pay the long-term debt with a current free cash flow. And we would like to be able to pay the debt in under 2 years. So that is worrying. And does Restaurant Brands International pay any dividends? Yes, they do. It is a check, and the dividend yield is 3.2%. So the annual payout is at $2.16 per share. And the payout ratio, that is an X. It is 68%. And we want to see a payout ratio somewhere between 20 and 50%. Because if it is over 50%, then the dividends can be in trouble. they can become unsustainable. It is also an information for us that they spend so much money on dividends and they could spend them on the growth of the company or paying back debt, which is very substantial. So are the dividends really such a great idea for this company? Well, doesn't seem like it. And what about dividend growth? It is a check. It is 23.8% 5-year growth rate. So the dividend is growing extremely fast. But luckily, for the last 3-4 years, they really slowed down this growth. So if they keep this trajectory, the payout ratio should get below 50%. So that is a wise strategy. Okay, so now let's value this company using a discounted cash flow formula. We will have to estimate the growth of this company for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. So in the low, we will estimate the growth of 5% for the first 5 years, and then let's say it will slow down to 3% per year. In the medium, 7% and then 4%. And in the high scenario, we will go really high, 13% for the first 5 years and then 7%. So with such estimates, the intrinsic value in the low scenario is $17, in the medium $22, and in the high one $41. But these are not the prices we should be buying this company for. We have to always add a margin of safety. I use a 30% one. And with such a margin, we get $12 in the low scenario, $15 in the medium, and $29 in the high scenario. And the current price is around $65. And such a low valuation is in a big way influenced by the debt of this company. And it is massive. So we have a company with a very strong moat, made by great brands and really nice profit margin. And it is a part of a portfolio of Bill Ackman, so one of the most successful investors out there. But this company also has a massive debt and a dividend that is slowing its growth. And on top of that, the price seems quite high. So let me know in the comments what is your view on this company and its future. And remember that before making any financial decisions, you should always do your own due diligence, and that this analysis should be treated only as the first step in understanding this company. That's all for today. Thank you very much for watching, and remember to like this video if you found it interesting and subscribe to the channel if you want to see more videos like this one. Thanks again, and bye-bye.